Hello, welcome to a brief overview of financial statements by Dr. Melissa Cohen. This brief agenda is going to take a look at the overview of financial statements and businesses. We are going to list the three statements and go over briefly why they are needed. We're going to look at some definitions and descriptions of what these financial statements are and then have any questions at the end. Let's first begin by telling you what the financial statements are. So there in business are typically three statements. These are the income statement, balance sheet, and cash flow statement. These are necessary from a company and getting this information from a company simply because each statement, it gives a different piece of financial information. Tells whether how much cash it has, how much debt it has, is it growing, is it a stable company, does it have too many debts that it needs to pay, or how is a company functioning overall? And how much money is a company making or losing? Another reason why these financial statements are necessary is because it's one way to standardize financial reporting across all the companies in the United States. And the noted reason is it's actually part of the SEC regulations. So the SEC is the Securities and Exchange Commission, and part of their laws and regulations when there's any public debt or any common stock issue is that it requires certain documents, and these three documents are required and posted quarterly for all the shareholders and as part of public record about the company. And the reason for this also is so that if an individual who wants to buy stock and therefore become an owner of the company, they need to have some way of doing their own analysis to find out how the company is operating and if it's a solid company and whether or not they want to spend their money with that company. Now, just for one example here, we're going to look at Apple, their consolidated statements for fiscal year 2020, second quarter. And just to let you know, this is their consolidated statement from April of 2020. So let's go to, so let's look at the actual income statement. So what is the income statement? It basically tells you how much income a company makes, right? And so income is defined as revenue minus your expenses. So income is revenue, which means how much money did the company bring in minus the expenses. So you actually had to pay money to make money. So if you had your own lemonade stand, and at the end of the day, you made $100 off of your lemonade stand. Well, we need to take out the expenses. That includes your lemons, your cups, your sugar, your water. You have to pay someone, or if you did it yourself, if there were any labor costs, to set up the stand as well. So then let's say you spent $20 with the materials. So your revenue from for your lemonade stand would be $100 because that's how much money you made, minus $20, and that's how much all the items cost. So your income would be $80. Now, if we wanted just to take a quick look at this, the snapshot of part of Apple's income statement here, just want to go over a couple things here just to show you. You may want to notice here that in the top, in the parentheses, it says in millions. So that means all of these numbers, you would need to add 6 zeros at the end. And so obviously that becomes quite difficult to read, so they shorten it. Some companies aren't quite as well off or as large as Apple, so it just may simply say in thousands. But you do need to be aware of that. Now this is a quarter two for Apple. So it only has, if we look at the top 3 months ended, March 28th, 2020 and March 30th, 2019. And then it also has 6 months ended as well. So it actually doesn't have the entire year. It just has the last 3 months, so that it would be January 1st through March 28th of 2020. So I'm not going to go through all the information here on what's actually in an income statement, and it cuts off at the bottom. It tells you what their income actually is, and there's some additional information. So you do read these top to bottom, and then you want to find the correct information that you're looking at. If you want to look at 3 months, you want to look at 6 months. And one other thing to note is if you're looking at the annual report, it will do the last 12 months. So for example, it may be January 1st through December 31st, and then he'll do it compared to the prior year. Now moving on, the second financial statement is called a balance sheet. So a balance sheet is simply a snapshot of a firm's accounting value on a particular date. Now there's a lot of information in that simple sentence, but we're not going to go through that right now. But I do want to point out, though, that a balance sheet has two sides. It is commonly written in an equation for assets equal liabilities and stockholders' equity. So assets are typically on the left side, and then liabilities and stockholders' equity are on the right side. On this balance sheet, it lists it top to bottom, so it is marked out, and it's very clearly says assets on the top, and then it says liabilities and stockholders' equity on the bottom. Now, one thing to note about this equation is if assets go up, then something on the liabilities and stockholders' equity side must go up as well. And the reverse is true. So if the value of assets go down, then the value of liabilities and stockholders' equity goes down as well. And just to give you a little bit more information, a balance sheet analysis, it looks at how the liquidity of a company, basically, do they have more cash or do they have a lot of assets? How much debt do they have versus how much equity? And the value versus the actual cost. And that is a lot of accounting information in there, distinguishing between book value of accounting versus market value of what a product is actually worth. So let's just take a quick look here at this balance sheet, and like I said, it's just a snapshot here and it doesn't give the full page. But as I mentioned here, we have the assets on the top and we have liabilities and shareholders' equity on the bottom, and they must equal. So if we notice here, for total assets for March of 2020, it's $320,400. And remember, we did say it is in millions, so it would actually be $320,400,000. And so then if you had the full page on this document, you would also see at the bottom that the liabilities and shareholders' equity would also come to $320,400. Now moving on to the third type of financial statement, it's called a cash flow statement. And this reflects a little bit more probably about what the average American person knows, like how much money do you have coming into your business, and in your personal example, how much money is in your bank account. You know you get paid, let's say, the 1st and 15th of every month, and you know when your rent is due or mortgage, and you know when your different bills are due. So if you have a lot of bills due at the 1st of the month, then your cash flow is going to get pretty tight before your second paycheck comes in the middle of the month. But if you have to budget and plan accordingly so that you can buy all the things you need. So let's go back to the cash flow statement from a business perspective here. So this determines the amount of cash flow between two periods of time. And I'm not going to go into all of this in detail, but there are actually three types of cash flow you want to look at in this cash flow statement. You want to look at the operating cash flow. You also want to look at the total cash flow of the firm, and it's something what is called free cash flow. That means how much money does the firm have that they can access and distribute to creditors and stockholders because they don't need it for working capital or fixed assets. So truly, like what you and I would think, how much money is just sitting in the bank that you can spend? Or how much money, if you have any bills set up on auto pay, and it's not going to come up, hit your bank account for 5 more days. Well, while you have, say, $500 in your account, you also are planning on this auto pay to pay $50 of your electric bill. So you already know that. So that's a kind of a same situation. So your free cash flow would then be the $500 minus the $50 that you have already promised to pay. So that's kind of what this free cash flow concept is. And here is an example of a cash flow statement. There are different types of cash flows, and you also want to start with how much money do they have at the beginning of the period, and then how much do they spend in the different categories, and how much do they earn in the different categories as well. As you may know, there are some tax benefits and rules in here, and we'll go into that later, that makes the numbers look a little different. Other things you may want to consider is your accounts receivable and accounts payable. So that may mean people owe you money for work that you've done for them. They're still in the process of getting the invoice and actually writing you a check as your company. And the same in reverse, where for the payable, you actually owe other companies money for work performed for you. Now, just to summarize very quickly, this is just a very, very brief overview of the 3 financial statements used in business. We have, once again, an income statement that determines how much income that you have at the end of the day from running your business. The second one is the balance sheet, and if we want to remember, our nice equation is assets equal liabilities plus stockholders' equity. And then our cash flow statement, which simply tells you how much cash and where is all of that cash and assets located for a company. So thank you for joining me. My name is Dr. Melissa Cohen. I hope this provided you just a great start to learning more about financial statements in business. Thank you.